My name is Scott Marquardt. I'm the one of the managing partners here at BlueStem Wealth Partners. I'm hosting today again with Chris. Chris is a regular on this program, so every quarter we try to bring Chris on and really try to bring you guys some valuable information, kind of a high level of thinking of what's happening in the markets, the economy, how that's affecting your portfolios, and maybe some of the things that we're looking ahead as far as how we're building those portfolios and making changes and things like that. So there's no shortage of things to talk about today, Chris, as you can about imagine. Anything I do know that people are very people that watch this are very interested in your commentary as far as things that they don't necessarily hear us talk about or that we have area of expertise in. So, is there anything like that's just kind of top of mind for you that you think we need to cover today? Because I do have a few questions, just some things that we continue to hear, themes with conversations of our clients and things like that. So that we'll get into that. But just seeing if you had anything to kind of kick us off. And if not, I can fire away.
Oh, I got plenty. I mean, the first thing I'd probably want to talk about is how in the world did we end up wearing the same shirt, but I have the blue version and you have the white version. But
you're very observant, I guess. I didn't even know.
I just didn't even know we coordinated that way. But in any case, yeah, I've got a ton. I mean, I think the first and foremost area that I'd chat with would be jobs and the related wage growth numbers that are associated with it, and how that's going to interplay with what the Fed's thinking. But I can weave that into questions. So if there are things that clients are really asking about, fire away on those, and then I'll weave in kind of my comments. But I definitely want to make sure that we leave this with kind of a firm footing on what matters right now and what we're looking for. And it's going to be, jobs will be ground zero for that. So.
Yeah, for sure. Okay, that sounds good. I think so. I do think that we do have a couple. Just I would say themes, like the same kind of thing. Like we get into conversations with clients and, things pop up, conversations pop up. We're constantly being asked, where do you think the markets are at? Where are they going? And of course, that's always a loaded question, right? Mm-hmm. But artificial intelligence, AI, big topic out there, right? I mean, you've got, you've got the opinion that there's going to be massive job displacement or even worse, job destruction, right? I mean, like, jobs are just going to go away forever and never come back. And then you get the other side of the spectrum where people are saying it's going to be a massive boom of economic prosperity that's going to create all kinds of opportunities. And of course this way over here is not right and way over here is not right, and it's probably going to be somewhere in the middle, most likely. But what do you think? When you think about, one of the things that I always think about is the automobile, right? Mm-hmm. And how many people that were in the horse business, right? That whether they made shoes or saddles or were in the transportation business or whatever, those jobs basically all went away but were replaced by multitudes of other jobs, and other industries actually came about because of that, right? Because of the ability for people to move and that kind of thing. Do you think, and what is going to be the effect of that, right? Is it going to be over here, somewhere in the middle? And how's that going to affect portfolios and investment opportunity and all that kind of stuff going on?
Yeah. So just a small question to start out with then. Awesome.
Yeah, it's the most concise one that we have, right?
Yeah, you got it. Awesome. Well, so you got to frame it up in the way that we think about things. And so what makes our economy, what makes people wealthier, what makes people happier is essentially a function of productivity. So there's a thing called a productivity curve that we all learned about in high school, and that is you have a certain amount of population and you have a certain amount of money that you invest in that population. And so as you invest more and more into a population, you get more productivity out of that by training them how to do things, new skills, and so on and so forth. And it's easiest to think about this in terms of investing in one person. So when you first start investing in a baby, you're investing in them, but you're not necessarily getting a ton out of them, right? And you keep investing until they hit like teenage years, and then they start to produce something for you. And then they rapidly grow in productivity as you train them. You go to college or a trade school, they become masters in those things one way or the other. And then eventually they run out of their ability to be more productive through more training and education. They become that PhD or whatever that is, and they kind of top out, right? And so if you take that idea across an entire population, you run into the problem that you effectively ran into in the Middle Ages, right? Where you can keep educating and educating and educating people, but now you're bound by the number of educated people you have. So the way to create growth was population, right? More people. And that's, of course, what kings did, more people, more people. Now, it could be agrarian in nature that, the more people you have, the more food you need. But you understand that for years and years and years, how we grew as a global economy or even a small economy was this function of investing in people and the amount of people you had to invest in. Well, what changes all of that is technology. Technology shifts the curve. It moves the whole thing so that I could train one accountant 200 years ago. Now, when I gave that accountant in 2000 a personal computer, that one accountant could now do the job of 100 accountants, right? So it made that accountant, that trained person that we have, far more productive because we gave them technology, right? AI is just the latest in a long line of technologies. The car is another great example, right? Somebody can now be way more productive with their mobility than they could previously, right? And so on and so forth. So we have to have these big leaps in technology at a regular interval, or we're not going to grow as a society. We don't make enough people anymore, and it's very efficient for us to invest in them. So growth is completely and totally dependent on leaps in productivity. Does that make sense? Like how to see it? Okay.
It does. The only thing that I would say there is, just speaking from experience, sometimes the growth, the output curve, as you described it, with from babies to like teenagers, isn't always, more and more, right? I think there comes a point where teenagers, they might actually be negative at sometimes, the productivity.
They top out. Yeah, exactly right. Yeah. I think it's generational, honestly. But you get the point,
yes,
right?
I get
the overall
yes,
point.
Correct.
Yes. All right, cool. Yes, yeah. Making sure. So that's where it is with AI. And to your point, yes, I mean, every single time that there's a leap in technology, the most bottom jobs that the technology was designed to leap away from are affected, right? That's right. What technology is. It's taking the most inefficient parts of our world and making something more efficient. Well, the way that you take something that's really inefficient in our world is you throw people at it, which is the least job satisfying, very expensive, prone to injury, all the different things that you can line up. And these are the jobs that nobody wants, right? We take them, some people take them because we have to, right? But at the end of the day, not everybody grows up wanting to be that. So the whole purpose of technology leaps is to take that bottom section of workload that's the bad jobs, and I'm classifying a lot of things as bad that really aren't, but you get my point, bad from a scale and function perspective, and eliminating those to make everybody else way more productive. So it's utilitarian in nature. And then those people get retrained and absorbed into society. Now, the vanguard of that, the very first people that are disrupted, that stinks, right? And time again throughout history, like if you go back all the way into France when the loom came out and all these people who did the job of spinning yarn were out and there was riots and they burned down half of Paris because of the loom, right? So it always happens that way, but society then starts becoming more productive, things that never existed before. Think about all the industries that exist now since 2000 with the personal computer. Amazon didn't exist. You know what I mean? Like right. There's whole things we haven't even dreamt of that are going to exist now because of a leap, and people are going to go there and people are going to work there and people are going to be there. And that's what it is. So there is no math that's ever shown that a leap in technology destroys our society or is irrecoverable. It's always been the opposite. So the folks that are on that one side that say, oh, we're all going to be run by robots, not true. And there's no precedence to show that, right? But yes, some people whose jobs there's value in replacing through smart technology, they're going to feel that pinch. They have to get retrained, but the rest of society is way more productive and it's better off for it. So,
Yeah, I mean, because I have that, I have that revelation every once in a while where, you think about just, just the technology that we know today, and think about how you get a signal to your mobile phone that shows up on a screen. You can watch a football game, a baseball game, all of this data that just comes from, somewhere out in the universe into your phone, and you can see it. Back 50 years ago, that's not even imagined at this point, right? Or 50 or 60 years ago. And you go back and think about I go back to the car, and just think about the industries that were created or at least enhanced by the car, and it far outweighed the amount of destruction that it did in terms of, the industry for building, paved roads, for hotels, right? Because people were mobile, fast food restaurants, you name it. The list goes on and on and on. I mean, these are businesses that didn't even exist before the car, and now it's a huge industry. So I think part of that is when you were, riding your horse around, like you didn't even imagine that you would have a roadside restaurant, 15 miles away that you could get to, or you didn't even imagine, roads other than these gravel or dirt roads that were built, or, and so there's things out there that I think that we just can't even imagine are going to be industries 10 years from now because of this leap in technology, I think, and so I kind of lean on your line of thinking where that productivity is just going to create, significant opportunity in who knows what, and part of it is we just don't know. And I think that's probably where that uncertainty or that fear lies is we just don't know.
Well, and the alternative is when you do analytics on societies that don't climb the productivity curve, that don't innovate, that don't go through this cycle of burning things down that are aged out, they implode, they cannibalize themselves, they go away. It's a natural process that has to happen. The fear is that we don't have this. The fear is that we don't leap our productivity curve, because then you just have declining productivity, and then it's, that's where you get into really nasty recipes that include, I'm not a conspiracy theorist, but that's how you end up in civil war. That's where that comes from, because when the economic backbone no longer can support what population is here, that's a bigger problem than trying to figure out where to fit a really cool technology.
Yeah.
Yeah.
Very good.
Yeah.
Good. All right. Well, let's jump one other quick one here.
Quick one.
Yeah, exactly. So anytime we have performance, which has been really nice to have over the past 3 years, aside from 2022, going back all the way to 2020, we've had pretty good performing portfolios. Markets have performed well, economies performed well. Obviously that doesn't last forever. And so, when you start having a run of years like this, the R word comes up, the recession word comes up. From an analytics standpoint, just from a pure number standpoint, because that's the best way to look at this kind of stuff. What are you seeing out there? I've heard 2027. Of course, that's just a year. I mean, that's a pretty safe, 12-month span, right? Sometime in 2027. Well,
Yeah.
What are you seeing there?
Yeah. Well, I'll set the table by saying, if we go back to the end of 2022, beginning of 2023, all the famous people in the world were on TV saying, we're going to get a recession, the biggest recession we've ever seen in like the summer of 2023. And we were against that. We said, there's nothing in the data right now that should be giving people that type of conviction. If the data evolves to that point, great. But we weren't in that camp. And of course it never did. And 2023 was an amazing year, right?
Mm-hmm.
And that's a testament to, using facts to make decisions, right? Now, a lot of times, facts can extrapolate a high likelihood, But we just weren't calculating that same high likelihood that there was other conviction around. It's also a really good example of why you shouldn't listen to people on TV, because the only thing you're going to hear from them is how they're already positioned, right? They're talking their book. So if they're already positioned short, they're going to tell you to be short, that kind of a thing. But anyway, I digress. The main thing with recessions is that they are incredibly hard to come by. It takes a lot of pieces moving together in order to get a recessionary environment. And so that's part of the reason why we avoided one in 2023. But there are certain linchpin data points that have the highest correlation to recessionary environments. And one of those is the way that the jobs data functions. I told you to come back around to this.
Yeah.
So, right now, we have pretty soft jobs data. Not horrible, but soft. And they're getting a little softer. Now, jobs are a lagging indicator of what's going on in the economy. So by the time that jobs data starts to get soft, that means other things are fairly bad. And that's why you've seen our economic score for, the last 6-8 months or whatever be below the 50 mark, right? 40 down to 30, back up to 40, and now back to 30 again. So we're in this really inconvenient economic period where the data isn't bad enough where we want to begin running around sounding any alarms. We can actually have pretty good markets even with this soft of economic data. But if we do get that shock to the market, we're definitely in an area where that shock can last longer and be deeper than we're comfortable with. And so we just have to recognize that, be intellectually honest with the fact that we are in a natural part of the economic cycle. You go through highs and lows. We're in a bit of a low, but not all lows turn into a recession. And so right now, I would say that we're not recession imminent by any means, but it's a possibility, right? I'd give it a third of a chance right now. Normally in a normally functioning, I'd give you a 0% chance, right? But we've climbed up there. So it's not the high probability. It's not even close to 50-50. But it's there. And this quarter is going to be really important to see what that jobs data looks like, because the ball's rolling downhill, right? And the Fed's going to jump in the way of that boulder, and they've already started cutting interest rates and other mechanisms throughout the government to try to stimulate growth and roll that ball back uphill. Sometimes it works, sometimes it doesn't.
Right.
And we're again, I just want to reiterate, we're not to the point where we want to be altering how we see portfolios at the moment, but we want it to be a positive to you that we're clearly aware of the situation and we're monitoring it closely, so that if that time comes, we're ready to act. For lack of a better way of saying it.
I like that. I think that's the first time I've heard you say that is something to the degree where, what the story is that, recessions aren't the norm. Right. It's hard to create one. And I think we have to remind ourselves, we do have to remind ourselves, 3 out of every 4 years, roughly 75, to 80% of the time, markets are actually higher, which actually represents how we invest our portfolios from an equity standpoint, right? Most of the time, our portfolios are overweight equities. And now if we're not substantially changing how we manage portfolios today, but we know that there's an economic threat out there potentially, right? That's just another reason why we visit and revisit, your cash assets, your conservative stuff, especially if you're taking money, right? Recessions are a great opportunity for people that aren't, for younger people on here, people who are in their 40s and 50s who are still working and accumulating. Those are great. And recessions are, we've said this before too, they're healthy, right? They're a good reset. They get the greed out of the market, temporarily, if nothing less, right? And so I like those talking points, and I do think it's important to know that, yes, while we do look at that and we do make changes if it's convicting enough, if the data says we should, but it really has to be, we really have to be convicted of that. The data and the facts really have to, align in order to do that. And then on the side, as an advisor, our advisors are looking at opportunities to trim profits in good markets and set that money aside in conservative assets for kind of that rainy day. And so that's good.
Yep.
Very good. Well, 20 minutes flies. It doesn't take long, and we are about out of time. There was a couple other things on on the agenda. We're just not going to get to them.
What were they? What were the other things on the agenda? We can do quick hit one-liners like bang, 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 like 1 minute, bang, bang.
Sure.
We can do that if you want.
Okay. Yeah. Okay.
I'm curious if I can even do it.
Yeah. Well, like about this time last year is when, so first quarter of last year is when the tariff talk began, like
Yep.
really implementing tariffs, right? So, big shock kind of at first to the market, but then it was kind of like, okay, we're back to normal, right? So that was one of the things. Was the effect? What effect have tariffs had on the economy? So if you want to do the one minute on that, you sure can try.
So 1 minute would be a lot's going to come down to the Supreme Court decision coming up in Q2 to see what really happens with them going forward. They definitely have had an effect on inflation, and we can quantify that. It's there, it's real. But it might be exactly what the Fed needs to kind of throw their hands up at inflation and say, well, there's nothing much we can do here because we can't fight tariffs that are naturally forcing up inflation, especially in some sectors, and focus more on the jobs end of their mandate and drop rates, right? So that is a tariffs are kind of like innate now. The question is, will they continue, and how is that going to affect the Fed? Is really what we're waiting to see. And obviously, the news broke that the Trump administration has now filed, criminal charges against Jerome Powell, which I think all of us already know. This is just to get him to resign faster than May, so they can put their guy in. Which politics is a nasty business, but
yeah.
But overall, what that would do is potentially bring up the cut cycle, and potentially drop rates potentially faster, which would be beneficial for markets in the short term. But obviously we'll see how that plays out to inflation in the long term. So tariffs are there; they matter. But we'll see what happens here once the decision's down from the Supreme Court. So.
Sounds good. I think the other one that was kind of on there was just the whole bubble question, which I think ties into the recession stuff. So I don't know that we need to spend any time there around PE levels and all that kind of stuff.
Well, the thing I will tell you is that, from a valuation perspective, overall, we could be a smidge overvalued. But if you're in the camp saying, oh my God, we're way out above our skis, it's not true. Certain valuation metrics I could cherry pick to make a call. But if you're just looking at forward PE ratios, we're a little elevated, not that bad. Markets have certainly gone way higher from these types of valuation levels. And when it comes to the AI bubble, I mean, I really take offense is the wrong word, exception to the word bubble. Bubbles imply that something is hollow. There's nothing underneath it, that it's a facade. And that if you pop it, there's nothing there. We don't have that, right? All these companies that are running up are NVIDIA and Microsoft and, very stable, very valuable companies. And sure, maybe they got a little frothy, maybe that's true in certain sense. And if the froth goes away, you'll see some of that pullback, but nothing like a 2001 type of an environment at all. So that's my 1 minute on those.
Very good.
Yep.
Well, as always, we appreciate you taking your time. We know you're a busy guy. You got lots of other things to do. So yeah, so we appreciate it a lot. And for clients out there that see this, we like to get your feedback too. Like if this is something that was valuable to you, let us know. If it wasn't, let us know. We like to do these things for the benefit of you guys, and we'll continue to do it as long as we get positive feedback. And if not, then we'll pivot and do something different. So if you have any questions from this, reach out to any of your advisors at BlueStem. Best number to call, the central location, 612-464-0372. So appreciate everybody that's watching this, and your feedback is appreciated. And Chris, thank you again.
Of course.